How much more can we squeeze out of this market? How much higher can it go? How much higher can it go before everything breaks and it all comes crashing down? Stock market valuations are already pretty rich right now. The 10-year treasury bond yield is actually going up, which puts downside pressure on stocks. We had this massive blowout with Trump and Elon happen today. And it's like, what does that mean for Tesla? What does that mean for SpaceX? What does that mean for Trump, who doesn't want to let down on his ego? What is he going to do to these other companies with these tariffs? Is it going to crash the whole United States economy? Because that's exactly what Elon just said is going to happen in the second half of this year. So we're going to break all that down. And the primary focus right now is going to be on stock market valuations. And trust me, I get it. I know this isn't the most interesting thing to talk about, but we're all here to make money. I'm here to make money. You're here to make money. There's so much craziness going on YouTube where all these people make these videos. They try to rehook you in, get you to rehook, stay and watch till the end so that the YouTube algorithm pushes out the video. Those people make videos. They aren't real investors. I'm here with you all day long in my Discord, showing you my trades in real time, showing you why I did it, the mistakes and the profits that I made, because we're all just here trying to make money. So I'm here in the trenches with you guys. So I'm going to explain to you right now 4 charts that matter a lot. And if you understand these 4 charts, you're going to know why I took a lot of risk off the table right now and why I took a lot of profits, because the stock market did make a pretty big move in the last few weeks, and this is why I decided it was time to sell some of them. So we talked about this chart a bazillion times on the channel. This is the S&P 500 on the lighter line right here, and the darker line is going to be the S&P 500 earnings per share. I know we talk about this a lot, like I just said, but it just updated, and we have to explain this crystal clear so you understand exactly why, because I do put quite a bit of weight on this chart, and I think that you should too. And again, I know it's not the sexiest thing to talk about, and look at this one little chart right here. Remember, there's 4 total charts, but if you're here to make money, you will understand that this chart means a lot. So typically the stock market and the earnings per share, they follow each other in the long run. So you can see they started at a similar spot right here, the S&P and the earnings, but over here they're not ending in the same spot. And you can see the S&P 500 was all the way up here coming into 2025, but the earnings were all the way down here. So this distance is going to say how overvalued the stock market actually was. So essentially speaking, and I talked about this at the end of last year, I said that these 2 lines are going to touch again. I said I didn't know when they were going to touch. Maybe it would be a week, maybe it'd be a month, maybe it'd be 2 years. But I did say, I promise you they will touch in the next 5 years. And lo and behold, a couple months later, the stock market went way down on the Trump tariff stuff, and they overlapped, and the market actually went a little bit below the earnings per share line right here, which does indicate the market was actually a little bit cheap back then. But at the end of the day, it just barely touched that line and then immediately snapped right back up once Trump did the 90-day pause. And yes, we're not back at all-time highs just yet, but look at how far we are off this earnings per share line right here. It's quite a bit. So in theory, if the market corrects from where it's at right now, which is roughly 58.88, it could correct from that level right there all the way down here, go to the left, that could be 51, 52, which is essentially like a 15% drop. So this distance from here to here indicates that the S&P is roughly 15% overvalued, and the Nasdaq's going to be even worse. The Nasdaq's probably around 17% overvalued. So what I'm getting at is this. Market valuations matter for everything, because maybe you're like, well, Brandon, I'm just going to go buy NVIDIA stock or AMD or TSM or Apple or whatever you want to buy. And I'm going to say this. All boats rise with the tide, and usually all boats fall with the tide. So even if you think AMD is undervalued right now, which I personally do think AMD is cheap, but even if you think AMD is cheap, but the overall market is expensive, if the overall market happens to fall and correct back down to intrinsic value, which intrinsic value is just the true value, if the overall market corrects down, it's going to drag AMD down with it, whether you like it or not. So that's why it's critical that when you flow through how you're going to make an investment, you have to understand what is the general market valuation, and then you go into individual companies from there. You can't just say, I'm going to make a bunch of money on AMD because AMD is cheap if the overall market's expensive. All right, so let's hop into Discord just to show you some of the logic as to why I closed out some of the things that I did. And then we'll go back to the 3 remaining charts to show you why I feel like right now is a good time to sell a little bit and why I think the market's actually going to take a little bit of a dip. So today's June 5th when I'm recording this. These are some Tesla cover calls that I sold. I sold them for 1,016 bucks, bought them back for 358. So a little profit right there of 658 bucks. Very small trade again, but these little things start to add up. But this was a Meta one that I recently closed out. So I sold these Meta puts for 11,746 bucks, and I bought them back for 5,578 bucks. So that profit equals 6,168 bucks. So not bad right there. So $658 right here, $6,100 right here. And then I closed out a triple Q put that I sold recently. So I sold it for 13,882 and I bought it back for 88.76 right here. So when you subtract that, that's another $5,000. So 5,000 bucks right there, plus another $6,000 right here, plus a few $100 up here. We closed out a few things today. I'm not saying the market's going to crash, by the way. I'm just saying that when you sell options, specifically selling puts, and you do longer duration option contracts, but you happen to catch the bottom of the market pretty much perfectly, which is what I did. And by the way, I'm not saying every single trade that I make is perfect, but when you do capture the bottom very closely and then the market rapidly goes up from there, it makes sense to close out those trades if you're up like 50, 60, 70% on them. Because think about it, if it's a 12-month contract, which most of these were 12-month contracts, but I only held it for 1 or 2 months and realized the vast majority of the profit, you might as well just close that out because now things are more expensive, which means it's likely they're going to dip down. And then you just go rinse and repeat these trades all over again versus having to sit on those trades for the rest of, 10 months or whatever it was to try to squeeze out the other 30% of profit that you could get out of it. It was worth it to close that stuff out. And this first chart that we went into, this was a big factor as to why I closed that out because the S&P dictates everything and a NASDAQ chart's going to look very similar to this. So if we're this much overvalued, it's very possible that the market's going to correct back down to the mean line of growth, which is this line right here. This is called reversion to the mean, and the stock market usually will dip on that. So now let's go look at this chart. Let me get myself out of the way here so we could actually see it. But this is net revisions index. So basically what this means is this. These are earnings per share revisions, basically saying, companies are guiding for earnings per share to be this, but then once the quarters go by, they're actually revising their guidance down. So they're saying, months ago, I think earnings are going to be $1 a share, but then as time goes by, they're going to be like, oh, I think it's going to be 90 cents, maybe 80, maybe 70 cents. Maybe we're just going to pull our guidance in general. And that's not good. And you can see that's happening right here coming into 2025 towards the end of 2024 also. And basically that's just because the economy is slowing down. We saw with initial jobless claims today that more people are getting laid off and they can't find work. And when people can't find work, they don't have money. And when they don't have money, they don't go spend it. And the United States economy is a consumer-based economy. So if people stop spending money, we're going to go into a massive recession. So here's the third chart, and this one's pretty big too. And don't forget, there's 4 total charts in the next one that we're going to go into, number 4. It really shows everything. It shows you what happened in other crashes, what's going to happen in this potential crash. It just shows you when we're at a certain valuation level, what happened in the past, and then we're going to learn from that, and maybe it's going to happen in this one right now too. So this is going to build into that. So you can see this goes all the way back to 1985, and right now it's 2025, obviously. And June 5th of 2025, the forward PE ratio for the S&P 500, we'll just say it's 21.7. Historically speaking, that's high. I mean, it happened once right here, once right here, and once right here. So 1, 2, 3 times going all the way back to 1985. So that's 40 years. In 40 years, the market's only been this expensive 3 times. And the critical thing to understand is this. Yes, I think AI is big. Yes, I think this whole tech revolution is going to be massive. I think we're going to have self-driving cars, humanoid robots. We're going to have all this good stuff. But the question is this. Is it already priced into the stock market? Are stocks already reflecting that that stuff is going to work out? It's going to scale. It's going to boost productivity. It's going to boost the earnings per share of these companies. Is that already priced in the stock valuations right now? If you ask me, I'm going to say probably it's mostly valued in right now. So if we get that growth, great, the valuations are going to be justified. But if we don't get that growth, the stock market's going to correct lower because we're not getting that expected growth. So when PE ratios are up in this level right here, the market is pricing in that we're going to get that growth pretty much definitively. And of course, if we get it, we're good. But if we don't get it, the market's going to correct down like we saw right here. So you could do what you want with that information, but I'm big on not counting my chickens until they hatch because time and time again, things will come out of left field in the stock market that we weren't expecting, some black swan event. COVID happened, inflation happened, the dot-com crash happened, 2008 happened, 1929 happened. These are all crashes that nobody was expecting was actually going to happen, but then they did. So at a time that the valuation level is a little bit rich right now, it makes sense to take a little bit of risk off the table. So full disclosure, my net worth right now is roughly $2.7 million. I still have the vast majority of my money invested in the market, but leverage plays like I'm selling puts and I'm buying calls, like leverage bullish plays, I don't have much exposure right now because I want to have a bunch of margin buying power on the sidelines. So in the event that we do dip, I could capitalize on that and ride that next wave higher. I made a lot of money off the dip that we got on the stock market, which is this little dip right here. And this is chart number 4, which we're going to dive into why it actually matters, because this is the big red flag zone right here. And of course, right here looks kind of similar. But I made a lot of money off this dip. I had, minimal exposure on the top here for leveraged options. So when the market dipped, I had a lot of buying power down here to sell puts and buy calls. And I rode this wave up. I made a lot of money in a very short amount of time. But now that we made a lot of money, I'm now starting to lay low, as I'm calling it, and just waiting for more opportunity. So if the market keeps pumping higher, I'm going to buy puts or I'm going to sell calls, which are bearish plays. But if the market corrects lower, guess who has a bunch of buying power on the sidelines ready to just swoop in and capitalize? Me. And everyone that's in my Discord, they know this too. And everyone's kind of like following along with this because statistically speaking, it makes sense to do a little bit of de-risking right now. I will say this, if the market doesn't happen to fall, it doesn't matter because remember, I'm still very bullishly, oriented in the stock market right now. It's not like I have any short positions. I have no cover calls I'm selling right now. I don't own any puts outright. I have no shorting. Like every single thing I have in my portfolio right now, it's all long the market right now. It's all bullish on the market. I just don't have leverage bullish exposure to the market right now. That's what I really want to make crystal clear for you guys. Looking back to 1999, look what the valuation level of the market was. So the red line's the S&P, blue lines are the PE ratio levels of the S&P. So essentially, if the red line was on the blue line, that's the PE ratio the market would be at. So right now, as we talked about, we're roughly 22. And look at the last time we saw a level of 22 before. Once right here, once right here. What did the stock market do when we hit the valuation level here? It went down. Why? Came out of COVID, interest rates were at 0%, inflation came running super hot. The Fed raised interest rates. When interest rates went up, the stock market went down. Totally justified, and that was legit. And by the way, I made a lot of money off this dip right here too, because I think my Schwab account, the value was like $300,000 around this time. And currently it's like $900,000. So tripled my account in just a couple years. That's, a really good ROI there. But the last time that we saw a valuation level prior to this one was 1999. And imagine if you would have invested your money in 1999, you would have rode this huge dip down, would have recovered to pretty much even, and then you rode another dip down, and then it would have took you all the way back to here to recover back to even. So this was a pretty tough time in the market right here. And I'm not saying it's guaranteed to happen right now, but it's possible. And just to flip this whole thesis backwards, look at when the market valuation was cheap. Look at the bottom of COVID. It went all the way down to roughly 15. Look at the sharp recovery we had after that. Look at the 2008 financial crisis, sharp recovery after that. Market went straight up. Look at through this whole time period right here, the market was just ripping higher because the valuation levels were cheap and it wasn't really priced in for the growth that came. But right now, the growth is pretty much priced in. So it's like, how much more are we going to get? Is there any more left to come? So I know that I've been trying a bunch of different types of YouTube videos on here. Some of them I edit and put B-roll behind it. Some of them I just sit here and talk. At the end of the day, I'm an investor. I'm just here to give you guys value, show you what I'm doing in my portfolio to hopefully help you scale to millions of dollars in your portfolio too, because I've done it. I have a system that works. I have hundreds of people in my Discord that are doing my exact same system right now because I truly want to help you guys. There's so much noise out there. There's so many, YouTubers that aren't actually investors out there. They don't know what they're talking about. And I'm here to just show you what I'm talking about and proving why I do things that I do and just showing you that, the proof is in the pudding. My returns speak for themselves. I scaled from pretty much nothing roughly 7 years ago, and now I have a couple $1,000,000 and I did all this in a low risk way. I didn't have any advantage that other people don't have. I didn't have like the odds stacked in my favor. It's just the fact of spending 10 years in the market, figuring out what strategy actually works, and then implementing it into my portfolio right now. And me just doing it myself, yeah, that sounds great. And if you're wondering, like, can you do this in your portfolio too? The answer is yes, because there's over like 600 people that went through my course and they came in a Discord and they're all scaling their portfolios too. So if you're interested in doing that, click the link below. You get a 7-day free trial to hop in right now. Check it out. If you don't like it, cancel. If you like it, keep going, and I'll see you guys there.